And let me just introduce very briefly the three panelists who are here with us today. On my far left is Brian Fabry, who's the chief U.S. economist for North America for BNP Paribas. To his right is Larry Cantor, his chief of research, head of research for Barclays. And immediately to my left is Mark Chandler, global head of currency strategy at Brown Brothers Harriman. What's interesting about this group is that every one of them has at least 2 graduate degrees. 2 of them have worked at the Federal Reserve, so you've got considerable economic knowledge in this panel. We're going to break this promptly at 11:45, so everybody can get over to the Waldorf Astoria for lunch. Those of you that have luggage here, there is a green room which is out behind these 2 doors to the right. That room will be locked, so if you want to put your luggage in there while you go to the Waldorf Astoria and have lunch, you may do so. So, without any further delays, Brian, do you want to start off?
Be delighted to, thank you. Well, I want to start off on a positive note. The world is recovering today, this quarter, from probably what one will regard as the deepest and longest economic recession that we've had since the Great Depression. The story, I think, is quite positive as we start to think about where we are relative to where we were. Financial markets have essentially recovered almost in all categories, especially in the United States and especially in the corporate bond markets. There's one major exception, which I'll talk about in a couple of minutes. And as a result, we're likely to see GDP grow, well, maybe 3.5%, even 4% in the second half of this year. Largely, it's a statistical thing. Businesses decided that they didn't need all of the inventories that they had at the end of last year, and so frankly, without any new financing, they just worked down their inventories. Production and trade dropped everywhere around the world, and then consequently, it has to start up. It did. I mean, the auto industry is a great example of how this all worked. Remember, the auto industry stopped production in May and June, and then all of a sudden it started it up in the end of July, and consequently, the numbers here, but really everywhere, looked like a steep decline in the first half of the year, and now it's going to look like a relatively steep increase in terms of industrial production, in terms of economic trade, global economic trade, and so on, and everyone is participating around the world and to some degree in this pickup. Don't forget, we also have lots of fiscal and monetary stimulus in place. The government, as you know, created 2 fiscal stimulus packages. They provided some strength to consumer spending power, certainly in the spring of both of the past 2 years, and consequently, there's still some monies left in that fiscal stimulus package to be used. But once it's all gone, and certainly the Fed was responsible for creating all kinds of wonderful, innovative strategies to avoid financial catastrophe. But once this ends, Fed stops buying in December securities, most of the fiscal stimulus runs out, then we start thinking about next year. And that's really sort of the title of my theme, what happens next year? Not just here, but to all of the advanced economies around the world. What happens? Where's the new stimulus to come from? Ordinarily, we would have to think about creation of jobs, creation of income for consumers to spend, and so on. And frankly, I think that's one of the problems that we will have. We're not likely to see significant job creation over the next couple of years. It's that way almost every cycle. We've gone through the last 2 cycles when we used to, and I remember writing these things, I'm sure Larry did too, the jobless recovery in the 1990s, and then last one was the job loss recovery in the 2002-2003 experience. So we really don't create lots of jobs when the economy starts to grow, and I think that's going to be very present right now. Since consumption's 71% of GDP, if we don't consume, we're not growing very fast. If government stops stimulating, I think that there's got to be something that takes its place, or else government comes back, and indeed it's my own view that I think we wind up with another fiscal stimulus package somewhere early next year. I think the Federal Reserve will continue to have to stimulate by buying more mortgage-backed securities, and then they'll all have to decide what to do about the commercial real estate problem that's looming. We think it's a very big problem because commercial real estate vacancy rates are rising, prices on real estate or commercial real estate are falling, and it's sort of the same thing that happened in the residential markets, only it's confined mainly to small and regional banks around the country. So indeed, there may well be a lot of those banks going out. FDIC will have to step up and take the brunt of that. They'll have to finance those buyouts or bailouts. And frankly, we'll be back in yet another situation. I guess my lackluster, really, the story boils down to this. We had a financial problem that we allowed ourselves to get into during most of the years of this decade. We built up leverage to unprecedented proportions, and we yet have not deleveraged sufficiently. And until that deleveraging really takes place, it'll continue to be a weight on GDP growth going forward. When we look at the rest of the world, Japan is in even bigger trouble. They're already in deflation. They're likely to stay in it. They don't really have the capacity for a lot of stimulus, and they've used up a lot of their personal savings wealth. Secondly, Europe. We think Europe's just about ready to start tightening things again, and we think it may even start by monetary policy measures before this year is over. And so therefore, when you think about Europe, once again, their potential for growth is even more limited than our own. They never really did manage a macro fiscal stimulus policy like we were able to produce. And consequently, their growth rates look really, really fragile. In fact, our own views about Europe are they barely grow next year. Where's the growth? Where's the good news? China. If you have a command-based economy, you just basically say, here's the stimulus, here's the money, start building. And basically builders, contractors, and everyone else went out and did it. And then they flooded the banks with liquidity. And unlike our own situation where banks basically held back, didn't use all the excess reserves, they went out and flooded the market with liquidity. And consequently, China's growing, in our judgment, over 9%. They really never fell into recession. But they now have another problem. Too much liquidity in China. Money growth, credit growth, everything is growing 30, 35%, and consequently, even they may have to start thinking about taking something off the table. So China is definitely growing. It's helping out the emerging world, and there's a big separation, in our view, between what goes on in emerging market countries' economies and advanced economies. The advanced ones are stuck in a rut. The emerging ones are growing pretty rapidly, and that's where we think you ought to put your money.
Great. Larry?
Okay, well, maybe we can make things interesting because I've got a different view than that, and
that's what makes economists.
So we can have a nice discussion and hopefully get some audience participation and some Q&A. I mean, the way we're looking at things is that we're in the midst of what I think will turn out to be, once all the data are in, a classic V-shaped recovery. What's interesting about it is that we've already pretty much seen it in Asia. The truth of the matter, the Asia story is kind of old because, as Brian pointed out, it's actually not that China's going to take some actions to slow things down. They already have. And in fact, you can see it in the data that they've slowed things down. In our view, that's a good thing. And it's a good thing because, China doesn't release quarter-on-quarter GDP statistics, so you have to kind of interpolate it. But by our estimates, and this is consistent with most people's estimates, GDP growth in the second quarter was something like 16% at an annual rate. And even for a country like China, that's way above what they can do on a sustainable basis. I would say by their definition, they probably did go in recession because quarter-on-quarter growth slowed to as little as 5 or 6%, which by China's standards is way below potential. They did unleash quite a bit of credit growth, although it's important even to put that in context because unlike the rest of the world, before the crisis hit, China was actually restraining credit growth. So there was much more scope for growth. And then when you also consider that China, nobody would argue with this, has massive infrastructure needs in terms of the need to build highways and schools and electronic circuits and the like, and no one would also doubt that they don't have the wherewithal to spend this money. So in our view, the fact that the Chinese authorities are taking action at a relatively early stage to slow things down at a more sustainable rate is good because if they didn't do that, they'd need a much more abrupt and I would think much more destructive policy tightening later down the road. But China's not the whole story. If you look at almost every country in Asia, it looks like a V. Japan's a bit of a different story, but whether you're looking at Singapore, Hong Kong, Taiwan, across the board, Korea certainly. In fact, Korea, right now, it looks like the V is pretty much complete. In other words, they've regained all of the lost output and is, we think, on the verge of slowing to a more sustainable pace. The interesting thing is that no one is extrapolating this to the more developed countries like the United States and countries in Europe. If you look at where GDP growth is right now in countries like Germany and France, it looks like it's around, it has a 3 handle or so, 3.5% or so. In countries like Germany and France, that's actually above trend. That's a rapid rate of growth for those countries. Then, of course, we move to the US, although I agree with Brian, I don't think that growth is going to be strong on a sustained basis in most European countries. But I do think it's happening in the US, which is a contentious point, and I recognize that most people don't believe that this is the case. One thing I want to talk about, though, is a little bit about inventories, because as Brian said, that is a big part of the story. Brian referred to this as statistical. I hear a lot of people say this is a technical thing. I don't know if it was statistical and it was technical, why wasn't everybody saying that on the downside? The truth of the matter is that inventories played a huge role in the decline in GDP. And it is playing, or actually it's forthcoming, most of it, a big role in the increase, and it always does, always. Go back and look at every single economic cycle, and you'll see that inventories play a very big role. And by the way, we're in the midst of the mother of all inventory cycles. This one's bigger than any of the others because we had a much bigger panic effect, both on the part of demand and then the response of firms. When you get in a recession, and this was a real recession, firms go into survival mode. And what they do following the collapse in demand is they cut output drastically. They want to get their inventories down to as low as possible. They cut payments to suppliers. They shut plants. They lay off employees. And they did it big time. Then what happens is demand stabilizes at a low level, which actually happened around the turn of the year. It's still weak, but it's grown a little bit, but it's at low levels. But output just kept falling. And as Brian says, the auto sector is a great example of this, where you get to a point where production is so far below spending that you've got to catch up. That's what starts it. It's not the consumer. The consumer never leads you out. It's when firms have to rebuild output, which cuts the layoffs and even causes hiring and so forth, an increase in hours. That's how the process started. That's what's happening this time. So now, if you go back and look at the patterns of business cycles, and in my view, we haven't had a real recession in over 25 years. Brian talks about the jobless recovery, and he's right. The last 2 recoveries had very little job growth, and in some cases, Brian noted, job losses. But in my view, that's because they weren't real recessions. The last US recession, so-called recession in 2000, 2001, do you know we didn't even get 2 consecutive quarters of negative GDP, and GDP was never negative year on year. Housing and autos, the 2 most cyclical sectors in the economy, never even went down in the last recession. This was a real old-fashioned recession, and we lost millions of jobs. The unemployment rate went up 5 percentage points or so in a year. That's what happens. It feels like the world is ending. And when that happens, because employers are so drastic in cutting workers, to rebuild output, they got to bring workers back on. We'll get the test of this pretty soon. If I'm right, by the end of the year, you should see net job growth before the end of this year, and we're getting pretty close. There's only 4 more employment reports to go. If job growth is still negative through the end of the year, especially if it's significantly negative, then we are going to have a problem because the consumer is unlikely to come back. If the labor market doesn't come back, it'll stay weak. Right now, though, and this is important, you don't need strength in the consumer. Okay, so if you look at the other 30% of the economy, it looks like it always looks after a big downturn. It looks exactly like a V. Okay, inventories. So basically they fell almost $160 billion in real terms in the second quarter. What does that mean? What is that? Inventories are just the difference between spending and output. So if spending's 100 and output's 20, inventories of 80, inventories fall by 20. How big is that? Just to get output back up to spending. If spending doesn't increase at all, you're talking about more than 5.5 percentage points of GDP. It's huge. Housing. What's going on in housing activity? And this is maybe a word that's going to shock all of you. In growth rate terms, it's booming. Single-family housing starts already are almost 40% above the bottom. Is that a great level? No, it's very, very weak. It's just that we got to practically zero. That's what happens in big recessions, and that's what's going on now. Trade. Okay, for the first time in I don't know how many years, trade is actually adding to growth, mostly because of A, a very cheap dollar, and B, because the US, contrary to previous business cycles, was the last out. So we've got strong export growth and relatively weak import growth. Even CapEx, which tends to lag the cycle, in fact, in most recessions it declines for a year, is going to turn positive, judging by capital goods orders. So the big negatives are over. This is important, okay, all these things. For example, residential construction had been subtracting a full percentage point from GDP growth on average every quarter for 3 years. As soon as the second half of this year, you're going to see a positive. That's a positive growth. That's a very big swing. So you are going to see a V. You're probably going to see in the second half of this year somewhere between 4 and 5% US GDP growth. And by the way, that wouldn't be all that spectacular given how hard we fell before, but it's going to feel a lot better. Let me end here because I don't want to overdo my time here. What's the big risk to markets? I would venture to say that most of you would say that it's going to be that the recovery falters. Okay, it's not going to be as strong as you think. I think that those concerns are misplaced. This recovery is anything but fragile. It's spreading around the world. You've got the big inventory cycle. The cyclical sectors are coming back, and there's tons of policy in the pipeline. Not only are rates about zero, the Fed still has another $500 billion or so of securities to buy. That's not the risk. The risk is that when people recognize that this is a real recovery, they're going to also realize that crisis settings for policy, which is where we are now, are no longer appropriate. And when that happens, in conjunction with the Fed not buying these securities anymore, you're going to get a very sizable rise in interest rates, and that is going to make the going a lot tougher when it comes to financial markets. So I'll just stop there. Mark.
It's hard to follow that. I guess I come from a little different perspective, but I would say that generally, as far as the sort of the debate between two former Fed economists, I'm sort of in the middle. I should be, I guess, is I do believe what Larry was saying, that we get a much stronger recovery than people expect, not just for the second half of this year, probably into the first half of next year. A lot of the fiscal stimulus is still in the pipeline. It still hasn't been spent. Will be spent next year. So I generally agree, more bullish on the economy. But what I really like to do is talk about put these things into a global context. As a currency strategist, that's where I really spend my time. When you buy a bond or you buy a stock, you could always sell it and buy another asset class. But when you sell the currencies, you've got to stay in the currency universe. There's no such thing as getting out of the currency universe. And so I really would like to do is just spend my few minutes here just explaining why I am, despite all the pessimism about the US dollar, central banks diversifying reserves. We heard from the earlier panel that our model of what someone said was laissez-faire capitalism is over. For me, I don't know about this laissez-faire capitalism. It seems to me that we've never had that in the United States. Keynes writes a book in the 1930s saying the end of laissez-faire. So where are these people today saying this is the end of laissez-faire just because the government's getting more involved in the economy? Before this recession hit, there's different ways to measure the size of a government. One way to do it is expenditures as a percentage of GDP. Before this recession hit, the US government expenditures percentage of GDP was 33%. The government was already consuming 1/3 of GDP before this crisis hit. So it looks like the role of government is going to increase on a semi-permanent basis, though not as big as it looks right now. But Europe is at 50% of GDP. And that's the other thing I guess that strikes me, is that we can look at our own navels and chastise ourselves for the light regulatory environment, for Federal Reserve keeping rates too low for too long. And yet many other countries in the world have been hit by a deeper economic downturn than the United States. Their banks are even more leveraged than ours. Look at European banks. Look at the UK banks, for example. The UK banks' assets were 4 times GDP. 4 times GDP of the UK. US bank assets, and that's with our 8,000 banks, less than 1 times GDP. Size matters. That means that we can have easier to absorb these problems. Think about those UK banks. A 5% drawdown in asset value, which is about what Bear Stearns experienced before they closed down their funds. 5% loss of UK banking assets cost them 20% of GDP. It's amazing, these numbers. We're nowhere close to that. The story I like to tell people about why I'm optimistic on the outlook for the, I would say, the durability of the dollar, durability of the United States economy within the world economy. A story about these 2 boys being chased by a tiger. One of the boys stops, puts on a pair of gym shoes. And his friend says, "What are you doing? You can't outrun a tiger by putting on running shoes." And his friend says, "I don't have to outrun the tiger. I just have to outrun you." And the point is that as bad as it looks like in the United States right now, I think that the United States is has the best chances of emerging from this crisis stronger than other countries. I think we'll emerge from this crisis like we emerged from the Great Depression, from World War II, stronger than we go into it. The reason we're going to be stronger is partly because our economic system is more flexible. I know many of you are thinking the flexibility of the labor markets. But this is how I experience the flexibility of the flexibility of labor markets. My boss can fire me for any good reason or any bad reason. I'm hired at will. That's the flexibility of labor markets. My father was a plumber. This is before they became drain surgeons, right? He was able to support a family of 6. One man's blue-collar income could support a family of 6 in the 1960s and 1970s. You can't do that anymore. The problem is not that these people who don't have income, jobs, or assets, these ninja loans, were pulling a fast one on Wall Street. The problem is that our means haven't kept pace with the American dream. The American dream is not having more shoes like my wife does, so Imelda Marcos comes over to the house to borrow shoes. Right? The American dream is having a house, having kids that go to college. That American dream, as TIAA-CREF knows, if you look at their website, tells you how much it costs to send a kid to college today. It's beyond the range of most Americans. Family income in the US, median family income is not much more than $50,000. How do you spend $250,000 to send 1 kid to college? Problem is, here's how I sort of see the problem. My father had an income that was kept pace with inflation or productivity. That was decoupled sometime in the early 1970s. So out of all the goods and services the US produces, one of the things we produce very well, we could turn a necessity into a virtue. And what we did is after the early 70s, when males' income no longer kept pace with inflation or productivity, we sent women into the workforce. That's a good thing, right? The family is working more hours. That's how the family began making ends meet. Then, adolescent children began working at an earlier age. That still wasn't enough to make ends meet. How do we make ends meet? Credit card. And so the American consumer, American household, the American worker, was at a disadvantage in this crisis. This is why Studs Terkel, his book about the Great Depression, wasn't called the Great Depression. It was called Hard Times. Because for most people, it wasn't a depression, it was just more hard times. Same thing with this crisis. Yes, there's a lot of Americans that are out of work, though most Americans in the workforce are employed. Most people are making their mortgage payments. For me, the crisis is one of a systematic problem of wages not keeping pace with inflation or productivity. That's because our employers, our socioeconomic elites, since America, of course, doesn't have classes, have been so, and this is part of the problem. This is what's happened. This is why I'm positive on the economy, like Larry. I think what's happened is our employers have been ruthless. As much as they cut production, they've cut workers even quicker. So what this means, productivity has gone up. You know, our jobs are not being lost to China. China is losing manufacturing jobs as well. Most major industrialized countries are losing manufacturing jobs. This is a good thing, because people are being replaced by machines, technology, productivity. You know, I think about the, you know, when I was younger, I used to want a secretary. Remind me when my anniversary is, do my typing, right? Where have all the secretaries gone? I think they've gone to Puerto Rico or China. No, they've been replaced by Bill Gates' Microsoft Office suites. What about bank tellers? All these bank tellers. We don't have as many bank tellers in New York or any of the major financial centers anymore. Where'd they all go? They go to China? No. They've been replaced by ATM machines. This is a good thing. What makes me optimistic about the United States is that the dollar, we've survived this crisis, and the dollar today is as important in the world economy as it was 20 years ago. Many people talk about the Chinese. You know, we're getting ready for this G20 meeting. People say, well, the Chinese are talking about SDRs, reform of the international monetary regime. When we know very well when our politicians are lying in the United States, right? Because their lips move, right? But somehow, when politicians in other countries speak, we take them at face value. So the Chinese talk about moving out of the dollar. But here's what they've done. Since the middle of last year, I should say in June, end of June of last year, the Chinese reserves, which they don't tell us how they're allocated by currency, but the US Treasury data showed that the Chinese owned roughly, out of their reserves, about 27% of them were in US Treasuries. At the end of June of this year, about 36% of them were in Treasuries. There's no evidence whatsoever from the IMF data, which is the most authoritative source, that central banks have diversified their reserves out of the dollar. Roughly speaking, the dollar is 2/3 of reserves today. It was 2/3 of reserves in the early 1990s before the run-up to the Eurozone. The euro, back in 1999 when the euro was born, many people were writing at the time that the euro was going to replace the dollar. The euro today is slightly bigger than the sum of its parts. Its parts, the écu, the Deutschmark, and the French franc. Not only is the dollar the world's key reserve currency, but it's also a very important invoicing currency. When China buys iron ore from Australia, they pay US dollars. Not only commodities, from energy, the hydrocarbons, precious metals, industrial metals, food and fibers, all quoted in dollars. But many countries, look at Italy for example, they have the euro. 51% of Italy's exports are invoiced in US dollars. The bulk of South Korea, Taiwan, Malaysia, Singapore's exports are invoiced in US dollars. I think that it's right for China and India, China, Japan, India, Russia to say there's not much of an alternative for their reserves. They have too many of them because they're so reliant on exports. Look at what happened earlier this week, Kazakhstan. They said they have roughly $17 billion in reserves. They say they'd like to move them, but they don't have an alternative. Say, come on, seriously? Any country, look at Canada, our biggest trading partner. Over half of their reserves are not in dollars. Something like 26 billion of their reserves, half of them, are not in US dollars. Surely Kazakhstan has a choice. China might not have a choice. I say too bad. They rely on exports. They export roughly 40% of GDP. So does Germany, export about 40% of GDP. What we've developed in the world is the imbalance. Can you imagine what's going to happen at this G20 meeting? Treasury Secretary Geithner will tell the G20 something like this, sort of in my fantasy. He'll say, you know, you people have been complaining about the overspending of the US consumer for a couple of decades now. And here's the good news. The American consumer is pulling back. They're deleveraging. Right? I agree with Brian. The country as a whole is not deleveraging because we're transferring the debt from the consumer sector, household sector, to the government sector. The country as a whole is not deleveraging, but the American consumer is. They say, this is what we're doing about the large deficit. We're reining in the American consumer. He says, and now we'd like to hear what you people, what you Europeans, the other G20 members are going to do about the global imbalances. Merkel, who's running for re-election in Germany, who's going to be at the Pittsburgh G20 photo opportunity, she's going to say something like, I'm sorry, but Germany is committed to our export engine. We have rising unemployment. What else can we do? We export. That's what we Germans do. The Chinese are going to say the same thing. We have 800 million people in the rural communities living in abject poverty. We can't give up our export-led machine. How are the global imbalances going to change? Frankly, I don't think they will. And this is really my answer to some of the problems, some of the structural problems that Brian pointed out. I think it's the old classical political scientist answer for these problems. I think this is the most likely outcome. Muddle through. Thank you.
Great.
Just to go back to the Obama package, looking at it very carefully along with CBO, 18% of the $800 billion roughly went for infrastructure. And from what I understand from Congress today, not $1 of that portion of it has been spent. It may still come down the road over a distributed period of 4 or 5 years, of course, but not much really went for infrastructure in spite of the rhetoric.
And I think that's a good point, too, because I think of that same thing when it comes to Chinese data. We talk about how strong the Chinese economy is. Here's one of the things that they consider retail sales. They count retail sales as when the good goes from the factory to the store. That counts as retail sales. In the United States, we only count retail sales when the consumer actually buys that good. And so I think that for me, I think we've got to look at these numbers closely. And I don't think that we've lost some faith here with not simply because of our economic downturn. But we've lost faith that democratic capitalism is a superior economic model to authoritarian capitalism, like China might have or Russia may have. I think that we have to really re-examine our own core values. Do we really believe in democratic capitalism? Does China have an advantage of us because they're authoritarian? I don't think so. Democracy, we have to believe, is both an ends and a means.
Great. All right, let me open it up to the audience. There are microphones on both sides, and I'll try to recognize you in the order at least that I see you. Yes, ma'am.
I'm Erica Karp with UBS. My question relates to the insidious dangers of protectionism. And Mr. Chandler, your comments regarding the intention of the Chinese authorities, from my standpoint, making those comments is not helpful. In fact, it probably instigates kind of things that are counter to the FPA's policy of informed discussion regarding foreign policy. So I think that maybe we should all be really open-minded about what the intentions of the different authorities from around the world are. And so I think we should avoid using historic kind of quotes that are actually really exclusionary. Okay, so just a thought.
Did I say something wrong?
Yes, when the Chinese authorities.
Oh, okay, can we have the question?
But the question relates to the challenges of protectionist leanings that we're seeing. And it's very insidious. It might not be some of the dialogues we're seeing at the G20. It might not be related to the tires thing that's going on right now between the US and China, but more subtle, more about purchasing agreements, intercompany. Could you guys talk about your fears on the possibilities of protectionism really dampening the growth inordinately the way it did when we had Smoot-Hawley and everything else after the recession? So protectionism is the question. Yeah,
well, let me respond to that. This is one thing. It's probably hard to find an economist anywhere that supports protectionism. I don't know if I've seen many. So I doubt you're going to get much argument here that the protectionism is not a bad thing. I don't think anybody. I mean, you're welcome if you disagree, but I think all of us think it's a bad thing. And so everybody gets nervous when you see tariffs slapped on and threats of retaliation and that kind of thing. My own take on this is that the peak of the risk of this really snowballing and culminating in something like a Smoot-Hawley has actually gone down. In other words, that we've passed the peak. And that's just because we're in a lot better shape economically, whether you believe Brian's view of the world, mine, Mark's, or whatever, than we were 6 months ago. I think everybody would agree we're in and it's when things are going down hard that protectionism tends to rear its head most prominently. because jobs are being lost, and politically it's very attractive to come out and say, we're not going to allow any more jobs here to be lost to whomever, the Japanese or the Chinese, whoever it is. That becomes a politically attractive thing. So to me, now that things are going better, I think we're less vulnerable to that kind of thing really snowballing. The other thing is that, look at China. I mean, their trade surplus has gone down enormously because of the weakness in world growth. I think charging them with currency manipulation and that kind of thing is not something that's on the top of the agenda in Congress as much as it was maybe a while ago. So anyway, I don't know if you feel that way, but so to me the risk is lower, actually.
I certainly am sensitive to your view that certainly if we do get the employment growth that you think we will, then it diminishes as an issue. If we don't get the employment growth, you can read the New York Times and you can find a whole raft of reasons why labor is going to challenge a whole variety of trade contracts in particular with China, because they feel either China has imported, or exported I should say, environmentally impure products into the United States, which presumably under cap and trade should be taxed higher, or because they've subsidized certain industries and under all kinds of world trade agreements, then they're violating those world trade agreements. So I can see the issue continuing, and especially if the Chinese remain as adamant as they say they currently are about their currency. They currently say they want to maintain the stability of the RMB relative to the dollar. And clearly, we have this massive imbalance. We've got about a $250 billion deficit with China. And so usually you have, and Mark knows a lot about this, but usually you have currencies adjust away some of those really massive imbalances. Well, if the Chinese don't do that, then it becomes a sticking point, a sore point, and we have to go through other means. The other means, of course, are challenging them at the World Trade Organization levels or in the court systems or applying tariffs here and there. So, Larry, you're damn right. Nobody in our profession would ever say increasing tariffs is a good idea. It isn't. But politically, it's going to be a hot topic in the next 12 months.
Good, Pam.
I'm Joan Chevalier. I'm a speechwriter on Wall Street. We'll leave the name of the firm unmentioned, but I essentially translate you guys into the mouths of businessmen. So ergo, the financial crisis. But, and I love economists. You really contribute to my falling asleep very well at night when I read you. But in the critique of what happened with our recent financial debacle, there has been, I've only seen maybe one analysis of where was economics in this. We'd like to blame Wall Street. We like to, and it was an analysis of where economists failed by a non-economist. Perhaps there was one economist, I think, who kind of got what was happening. She happened to be a woman, but, and I can't remember her name, unfortunately. And Peter Drucker, the father of corporate management, of course, talks about us all having a problem with our own our blinkered biases, the intellectual biases that we bring to our kind of structures. I have a good idea of the biases that Wall Street brings to its structures. Among them, it was relying a great deal on modeling by economists and mathematicians. But has there been a critique, and what do you think about critiquing your own discipline in the wake of what happened?
I'll just jump in quickly. I'm sure Larry has a lot of points on this one. But there were a few firms on Wall Street that actually did predict recession, including my own, a couple of years before we actually got there. The housing crisis looked very, very bad to me, and it's sort of a sticking point that I wanted to bring up with Larry anyway. Housing clearly, as Larry said, is coming back in a percentage-wise big way. But there's two parts to the housing issue. One is the activity itself of building new homes. We're building new homes right now. The other part is the finance. In essence, our government has socialized the housing mortgage market totally. Totally. And so therefore, from my perspective, when I was looking at housing being totally overbuilt relative to anything like demand, and realizing that risk was just being transferred from from lenders out to principally somewhere out of this country, which a lot of that did happen, you knew that there was a financial calamity coming. And then when I learned that there was going to be more fraud in the origination of mortgages, and I did learn that relatively early, I knew we were headed for not just an economic problem, but a really big financial problem. And indeed, so people did know that. Now, I can tell you that people that Larry and I know who have big models and used big models basically didn't see it coming even after we'd make presentations to these people. And they believed in their models for a longer period until it actually happened. And then, of course, the big model producers in government basically then saw the light. But they didn't because of the models.
I'd say that maybe I'd give you a comparison. I have 2 watches. One watch my grandfather gave me. It's a nice handcrafted pocket watch. It doesn't work. But it's still right twice a day. My wristwatch, I set 5 minutes fast. It's never on time. It's never accurate, but it's more reliable.
Okay. Let me just, I don't know that that answers your question. But it's a nice anecdote. But just to, and I'm sorry we don't have any women economists here, so you may not want to listen to anything we say at all. But just in answer to your question, Paul Krugman actually in the Sunday New York Times Magazine did write an article, I think specifically, on the idea that economists got this wrong.
Yeah, you're right.
And I did not forecast how bad things would get. I actually don't know anybody who forecasted that it would get this bad, except people that have been saying it for 20 years. I don't want to mention any names, but people that are now touting out as the guy who predicted the financial crisis had been saying this for about 20, talking about a clock being right twice a day, a broken clock. So I don't know anybody really who thought it would get this bad. Now, to me, maybe you're probably right that the ability of economists to forecast things and control things was probably exaggerated. And I always think that when things are going really well, they give too much credit to policymakers like the former Fed chairman. And then when things get bad, they probably blame them too much also. In other words, there's a business cycle out there, and it's always been there. And it moderated for a while. And there were a bunch of reasons for that, such as a productivity boom associated with technology, the fact that communism broke down and we had all these low-cost suppliers come in, which really was never, policymakers didn't create that. They got a lot of credit, but they probably didn't deserve it in the first place. And then when it fell apart, I think they got too much blame. But to me, all the proposals I see going around now to try and prevent what happened from happening again are not addressing the issue. Whether it's higher bank capital ratios, limiting bank compensation, I obviously have an axe on that one, or preventing certain bank activities, to me is the wrong way to go and is not going to prevent this from happening. And that's because financial services industry is uniquely dependent on confidence more than any other business. So you go out and buy a stereo or a car, it's nice to have some confidence in whoever sells it to you, but you don't have to have it because you have the thing. When you put your money, and sometimes it's your life savings, in a financial institution, what do you get? You get an electronic entry or something. And if you lose confidence in that institution, what are you going to do? You're going to pull your money out. That's what happened in September. Although it was on the wholesale rather than the retail. Everybody pulled their money out, and then the system collapses. You need something to address that. My own view is you need to extend insurance beyond just retail deposits. And banks should be paying for that insurance, like they did to the FDIC, and they should be risk adjusted, just like car insurance. In other words, let the banks do what they want, but if they want to take riskier activities or leverage more, they have to pay a higher insurance rate on their deposits. Then you won't have that, you will not have that, or you could even have the insurance authority refuse to give the insurance if the bank or financial institution, whether it's an insurance company, takes too long. To me, the focus ought to be on that, because unless you're going to drive capital ratios to 1-to-1, which nobody's talking about, which I think would have very severe impact on the ability of the economy to grow, you're still going to have this problem. And we've had it for hundreds of years. This isn't a new problem. We had this in the late 19th century on a number of occasions. If investor confidence goes, that's what happens. And that's why nobody forecasted it. If that happens, it's over.
Social trust.
Right. I don't care how strong the financial institution is. Once everybody pulls their money out, no matter whether it's Brian's institution, my institution, Mark's institution, it doesn't matter. If nobody has confidence in that institution, as a financial services institution, that institution can't continue. That won't survive. So anyway.
Great. I'm going to do something a little different. There are three people who want to ask questions. I'd like to ask you, pose your questions succinctly, shortly, not simultaneously, but sequentially, and then we'll try to answer all three questions.
I'm Martin Charwat from World Affairs Council of the Mid-Hudson Valley. My question deals with China. China seems to be investing huge amounts of money in export-related industries at a time when exports are caving. What do you foresee as the result of these investments?
I'll take a quick one.
We'll just go to each question, then we'll...
Pauline Kirschenbaum, Chapin Associates. My question has to do with Social Security. About a year and a half ago, I had the opportunity to question Senator Hagel, who was then chairman of the Senate Finance Committee, about the deficit, the difference between the intake from Social Security and what they were paying out. At the end of fiscal 2007, there was a $650 billion surplus. We had a $450 billion deficit at the same time. So if you balance it out, we already had a $1 trillion deficit at that point. The question is, what are you foreseeing for the impact of the Social Security numbers this coming year, and what impact will that have on interest rates and your forecasting?
Zoe Blackwood, student at Brewer College, student University of New York. My question is, what advice or insight can you share with the younger people in the audience, the emerging global political and economic leaders, about how we can prepare for our futures 20 years from now? You hinted at perhaps expecting to fully fund our own retirement. So if you can elaborate on those sort of points, I'd really appreciate it. Thank you.
Should we each take one? Is
yeah,
that
why not?
a quick way to do it? You want to do the last one? I'll do China, and you do Social Security? Is that okay?
Okay, that's fine.
You started off with China.
Social Security. So.
Let's start with Social Security then.
Take another one if you want. Take it.
No, I think the idea behind, so you know, we've been ramping up Social Security payments, and we've been delaying the payout, and frankly, I mean, even Greenspan was involved in a commission maybe 20 years ago to increase the tax on Social Security. Clearly, it looks like that's the only couple of options left to the government. Raise the taxes. That is, you don't have to raise the tax rate so much as just allow the tax like it exists for medical insurance. Let the tax rate go up along with all of your income instead of capping it out at $90,000 or $95,000, whatever it is. So it increases the tax flow. That's number one. Number two, clearly we're going to push out retirement ages for people that wind up with, let's say, 100% of their Social Security benefit. Maybe it winds up coming to you at 72 instead of 67 or whatever it is today. I think that's an inevitability. It's just going to happen later. And people are going to work longer, and businesses are going to have to maintain employment of older people for longer periods of time. I mean, that's the humane way of basically dealing with it. And I think that these issues are basically on the cusp of being decided by Congress, you know, maybe not now because there's bigger issues at stake, but I think that has to happen very, very, very shortly. Will it be the solution? The real problem is really health care insurance rather than Social Security insurance. They can solve the Social Security problem with more taxation and delayed payments. It's health insurance. Medicaid is really the big animal that they have to solve.
I agree with everything you say. I'd add, I think they're also going to probably do means testing. In other words, if you have a certain amount of wealth, I wouldn't count on getting your Social Security checks. But China, I just, you know, if you look at the huge fiscal package, which is the only one bigger than the U.S. one relative to GDP in China, it actually was not focused on export-related industries. Right. It was focused on infrastructure. Right. And the Chinese government actually, for a long time, has wanted to reduce their dependence on exports and increase domestic demand. And so, you know, I think
they failed at that. They have not succeeded at all.
That's actually not true in the sense that they still depend a lot on exports, but domestic demand has definitely improved as a share of the economy. So it depends on how you define improvement. But there's no doubt that there's the big burst of spending you're seeing in China from the government is actually not on export industries. It's on building highways and roads and schools and infrastructure like electronic circuits. So I think that's changing. You may be upset that it's not happening fast enough, or, and that they're not allowing enough flexibility in the exchange rates or other topics, but it is underway. It's just a matter of whether you think it's fast enough.
I guess my question you asked was about the education, what young people should do, thinking about careers for the future. I'd say that a lot of these job losses on Wall Street, I think, are going to be semi-permanent job losses. Wall Street, I have some numbers that in the 1950s up to the 1980s, Wall Street accounted for about 10% of corporate profits. Right before the bubble, or during the bubble phase, it reached 34% of corporate profits. That is not sustainable. In terms of wages, in the 1950s through most of the 80s, Wall Street wages were about 3% of overall wages, and they got up to 7%. Again, that's not completely sustainable. I think that the U.S., and this is again why I'm optimistic, I think that if the U.S. previously in the global division of labor specialized in finance, I think we, more likely than other countries, can redefine ourselves, can redefine a global division of labor, and probably be less finance. So I guess I would think that maybe the answer to your question is well about economics and sort of self-critical analysis of our profession. I'd say part of the problem, it seems to me, is that we study economics in a vacuum. Economics is not about mathematical equations and formulas. I did not take an economics course until I was in graduate school. Most of the economics I learned prior to graduate school came from studying history. A historical social context for these things, for economics, for business. I would think also that we got to think about other potential employers of our skills. Mark Twain once said, don't let your schooling interfere with your education. And I'd say the same thing for us today, that don't think that an employer who's going to buy your labor power for 8 hours or 10 hours a day is going to be their sole definer of who you are. These days, I find that a lot of MBA students are leaving Wall Street and going to NGOs. So I think that we want to think about how to make the world better. And it turns out that if you just go after money, if that's what young people want, go after money, I'd say that it leaves a very short-sighted solution. The best thing to do, I think, is find something you do that you enjoy doing. By enjoying doing it, you give yourself a lot of practice at doing it, and you naturally get better at it because you like to do it and you're willing to practice. And with that practice and with getting good at something comes all those rewards that you might really be looking for. Money, status, prestige, soulmates, right? Everything can come with finding what you like to do. So it's not so much the economy is going to dictate that. You should look into yourself, do your skills inventory, think about what really motivates you.
Great. Well, please join me in thanking our panel.
I have the Chinese domestic consumption falling as a percentage of GDP. So from what